Welcome back to Financial Planning Explained, and I'm your host, Mike Menninger, Certified Financial Planner, host of the Financial Planning Explained, no kidding, owner and founder of Menninger Associates Financial Planning. I'm joined here today with one of my associates, also a CFP, Ryan Keefe. Thanks for joining me.
Thank you, Mike.
We're finishing up with the second of a two-part episode on Pete and Donna. Again, this is a case study. The purpose of the case study is not necessarily to hone in on the facts of that particular case, but what it does is it provides us with the opportunity to touch upon things that are helpful to be able to illustrate some ideas, strategies for everyone to think about, as well as the surrounding laws and things along that nature. So where we left off was we talked about the timeline. What I'd like to do is, before we get into some of the strategies and solutions, sort of just rehash some of the facts of the case. Ryan, you want to pick that up?
Sure. So Pete and Donna are a married couple. Pete is age 58 and Donna is age 57. Pete earns about $200,000 a year and Donna earns about $267,000 a year. And again, that's total compensation, bonuses, stock options, RSUs, things like that. We should also note that Donna retired actually in August.
So our income this year won't be the full 267, which is going to be important to discuss as part of our strategies and recommendations.
Correct. So when we look at their total portfolio, we look at Pete and Donna have roughly $4 million in 401ks and IRA assets. They have $150,000 in Roth IRA assets, and then they have about $660,000 in non-qualified assets.
Okay.
And as I stated, that Donna already retired this year. Pete is also considering retirement by the end of the year.
I'll believe that when it actually happens.
And we have a cost of living for both of them of about $7,000 a month or $84,000 a year. And they have two daughters who are both financially independent, which will come into play when we look at their estate.
Right, and so both of the daughters are well into their 20s and also very established in life, and both of which are making decent money, which is important to understand, because when you're doing any type of financial planning, particularly for those who have above average wealth, you need to take into consideration the next generation. And it's not only taking into consideration the financial situation of the next generation, but it's actually, these are planning things that you should be thinking about doing with the next generation, because not only, a lot of people don't like to tell their kids, hey, are you going to be inheriting millions of dollars? But there are certain things that you can do with the kids to drive them for long-term planning, taking that into consideration. So we talked about the timeline, okay, and their goals. Pete had basically said, look, I want to do Roth conversions. Ironically, he was referred to us by his accountant, which we do, and we have these discussions all the time. Where he learned it on the internet or whether he knew it already or anything else like that remains to be seen. They also wanted to figure out how are they going to live on, what are they going to live on until they begin to draw Social Security and or pensions. Okay, and that is a very important. They also asked us, what do you think we should do with regards to Social Security? And that's a subject of its own. Mm-hmm. And they also wanted to do some form of estate planning for their children, which was, they weren't thinking what we're thinking with regards to the distribution of the IRA assets and stuff like that. But we did talk to them about conceptual estate planning, okay? How it works, what they can take into consideration, utilization of trust, et cetera, et cetera. So that's kind of laying out their situation. So we talked to them. Diane just retired. And because of that, she won't have a full year of income, okay? And without there being a full year income, their income is going to be in the vicinity of about $350,000 this year, okay? And we've had these discussions before, segregating the difference between dividend and capital gain type of income versus ordinary income. And we're trying to keep the ordinary income within the 24% tax bracket. Now, that said, we've got other software that actually recommended running them through the 32% tax bracket. And if you look at the future of their tax brackets, we take into consideration more than the time horizons that we showed in the first episode of specifically, age 59 and a half, 62, 63, 65, 70, 70 and a half, and 75. We also look at lifetime horizons. Lifetime horizons are what we talked about there, but subsequent to that is in the event that either one of them dies, the surviving spouse, their income does not go down much, or certainly their taxable income does not go down at all. Their only income goes down by the amount of the second person, the lower of the two Social Securities, but now they're filing single. All of the rest of the income remains intact, okay, particularly RMDs. And then so we've got a whole bunch of years potentially of a surviving spouse filing taxes as single, impacting Medicare premiums, which are 4%, effectively 4% of your IRA distributions. Once you get above, it becomes tax. It's a tax rate, and that's not small. Okay, so these are things we take into consideration, and then the final one is the taxation to the kids. And if you're dropping a giant IRA on the kids, and we used that example in the first episode, but we'll use it again. If they died today, they're leaving $4 million in assets to their two daughters. Each daughter receives $2 million. They have to take it out in 10 years. And using an estimated growth rate of 7% basically means that they would have to take out 15% of that every year. That is $300,000 of taxable income, ordinary income, every year for 10 years. That is absolutely going to drive the children into the higher income tax bracket. So we take these into consideration when we work with our clients to forecast, if that's the right word, forecasting what the taxable rate is going to be. Not necessarily each individual. We're looking at that $4 million. Right. That $4 million is going to get taxed. So to the extent that we can reduce the taxation, increases the amount of money that remains in their household, in their family, and their legacy.
Correct.
And by the way, guess who loses?
Mr. I, Mr. R, and Mr. S.
Yeah, all three of those guys, which doesn't break my heart. I mean, other than the fact that we know that the government's going to spend it wisely. All right. Anyway, hopefully they're not listening.
Hopefully.
Yeah, they're listening to everything. We know that as well as everybody does. So, all right. So what are we looking at here? Well, for starters, the cash flow. All right. So Pete's going to continue working, and the amount of money that he makes is going to be awfully darn close to what they need for their income. Okay, except for one thing, we're going to be driving him into contributing to his Roth 401k.
Correct.
Okay, because he can contribute $30,000.
Right.
And so, in a way, even if it drove their income to be below their cost of living, effectively they can live off some of their savings money.
Correct.
Their non-qualified assets. And if you say, well, gee, why would you do that? In effect, in a strange kind of way, if he contributed 30 grand to his Roth 401k and he had to take $10,000 or even all of it out of savings to afford his cost of living, isn't that the equivalent of taking $30,000 from your savings and putting it into the Roth? It is.
It is.
And so it's a little bit of a shell game, but at the end of the day, that's what they're doing. And the Roth is a beautiful thing because it's growing tax-free. All right?
And one of the things that we impressed upon them in our meeting was you got about 1 to 2 years of that cash flow that he's going to need that they're going to want to carve out of that non-qualified account to be more conservative.
Correct.
Or safe. As we've experienced recently, markets can be volatile.
Right.
And sometimes that volatility goes on the downside. And
On both sides.
And the last thing that you want to happen is have that $600,000 go down significantly and therefore cause some cash flow
Right, when you need it.
hindrances.
So the whole idea there is what we tend to look at whenever it comes to any type of investment planning is future cash flow. And we take a look at it and say, what might you need at a cash flow for the next 2 years? And given that, we encourage to carve out a certain amount. So let's say, for instance, Pete's bringing in $6,000 a month. Well, that means we're shortfalling by $1,000 a month over the next 2 years, that's $24,000. We're going to need to at least set aside. It could be a money market. In today's interest rate environment, money market doesn't stink like it did 3 years ago. 3 years ago, you'd be lucky to make 1%
Right.
money market. Now, at least 5% is okay. It's adequate, it works, and we're good. From there, that still leaves a decent amount of money in their non-qualified accounts.
Right.
But what we encourage them to do with Donna is to keep a good chunk of her 401k assets with her employer.
Right.
Okay? At least until they both turn 59 and a half.
Right.
Okay? Once Pete turns 59 and a half, he has access to his assets. Once she turns 59 and a half, she has access to her 401k, and they're really not that far away.
No.
But it's just a good idea to save it because we all have emergencies at some point, and we just want to make sure that they have enough money to get them to when the cavalry arrives, which is age 59 and a half.
And speaking of emergencies, one of our other recommendations to them was to get a home equity line of credit.
Right.
So that in the event of a true emergency, and let's say markets are down precipitously and they don't want to reach into their investments, they have somewhere that they can go.
Correct.
For a large cash need.
Yeah, and as it pertains to the home equity line of credit, it basically gives access to cash. It's considered a loan, which means that you need to demonstrate income. Hey, get it when you don't need it. The odds of you need it is very low, but get it when you don't need it, because if you ever did, then it's there.
Yeah. And if you never touch it, it's like a credit card that you never use.
Right.
There's no interest charge. There's nothing.
Right, exactly. The bank may charge you to open it.
To open.
Okay, but get it when you don't need it also, because you have the income to show it, show for it. Okay,
Correct.
so yeah, we recommended get a HELOC. Doesn't hurt to have. Oftentimes we recommend that for a lot of clients. It's a terrific financial planning tool, because one of the most important components of financial planning is creating flexibility.
Right.
And the only thing is that always concerns me is you got to understand the behavior of your client. If your client is a spender and always looks for an opportunity to borrow to spend, then a HELOC may not necessarily be the best thing for them.
Right.
Simply because you're giving them the pathway to create a worse financial situation for themselves.
Correct. Yeah. I believe, as you always say in meetings, if the first words out of your mouth after opening a HELOC is woohoo, it's probably not for you.
Exactly. So anyway, so now what we do is we establish the Roth IRA conversions, okay? And there's a whole bunch of parts that go to this. One could argue the best time to do a Roth conversion is at the very beginning of the year, because it gives you the full year of tax-free growth. Okay, that's very easy to argue, because I'll argue it all day long, except for one problem. You put it in, and all of a sudden the markets drop. You
Like
do $100,000.
2022.
Like you do $100,000 Roth conversion in January, and in December it's $80,000. Well, heck, you're paying taxes on the $100,000.
Right.
Okay, that's one piece. The second piece of it is that you don't always know your limit, meaning that we're targeting to bring Pete and Donna to the top of the 24% tax bracket. You don't always know in the beginning of the year what your income is. So oftentimes what we'll do is we'll do a bunch in the beginning of the year. And then once we have a better handle on what our income is, we'll do the rest of it at the end of the year.
Right. And this can be especially tricky when we have clients who have, profit sharing distributions,
Correct.
K1s that come out late in the year, and there's just no telling what the profitability of the firm or their business will be. So we have to be very cautious, because once you do the Roth conversion, it's irreversible.
Right, that's correct. Under the new tax laws, new being 2018, it's irreversible, which I found to be one of the most inconvenient things associated with the tax laws. But the other thing to take into consideration is how do you pay taxes? And we're going to get to that at the beginning of the next segment. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained as we continue with this case study for Pete and Donna. Where I left off was we're talking about doing Roth conversions. And one of the nuances that we discussed was the taxes, okay? The federal government wants their taxes to be paid. That's why they do withholdings. But one of the things to remember is that they have what's called safe harbor. Safe harbor rule basically says that you need to get 90% of this year's tax in to avoid penalty, or 110% of last year's tax. Now, if you're running to the top of the 24% tax bracket for married, it's about 80 grand. So basically next year, 90% of 80 grand next year is going to be lesser than 110% of prior year. So what we need to think about is making sure that the federal government gets their 72 grand, which is 90%. So there's a few ways of doing that. They can send in checks quarterly, or first of all, Pete is still working, so we know how much they're withholding from his pay stub. We can increase his withholdings.
Right.
All right. The other thing that we could do, and we've done a lot of, is we'll project out that at the end of the year, if for some reason we're going to still owe 30 grand, what we'll do is we'll convert the full amount in January, carve out 30 grand inside the Roth IRA, put it into money market, and then in December, that's when the government can have their 30 grand. Oh, by the way, what happens is we did it on the Roth IRA side, which is the tax-free side. They got effectively 5%, or whatever money market rates are providing.
Right.
But let's say they're 5%. 5% of 30 grand, they made $1,500 in their tax-free account. All right.
Beautiful.
Now, that's great, except what we're doing is we're burning through the Roth IRA.
Right.
That idea makes sense twofold. Number one, you can't do it if you're not 59 and a half, otherwise it's considered a distribution. Okay. But number two is, in this case, we're trying to preserve the amount of Roth IRA assets to have. They have non-qualified assets. So what I would do in their case is either of two things. I would either increase Pete's withholdings or do quarterly estimateds or some combination thereof.
Right. And it's important to distinct that if he does the withholdings through payroll, it's as if he made that withholding throughout the year.
Right.
Whereas if he does quarterly estimated payments, if you do a Roth conversion in the beginning of the year, you're really supposed to start the quarterly estimated payments as if you
Right, in the beginning of the year.
conversion in the beginning of the
So if you're going to be owing 40 grand, then you need to be putting 10 grand in every quarter.
Yep.
Okay. And so those are the types of things that we want to plan for, because fact of the matter is it's one thing to pay tax. Tax penalties are stupid money. Okay. I mean, you're getting whacked with a 5 to 8% penalty. If you owe 10 grand, why am I going to pay an extra $500 to $800? That's silly. Okay.
Agreed.
So anyway, the other ideas that we came is possibly making the children a partial beneficiary of the IRAs. Okay. What you first really want to do is you don't want the surviving spouse to be living on hot dogs. Okay. But what this does is if Pete leaves all his money to Donna and then Donna eventually dies, what happens is the kids are effectively taking both IRA money and having to take it out over 10 years.
Right.
We've implemented this before where we'll take one of the spouse's money, as long as the surviving spouse is okay, we'll take a portion of the IRA money and send it directly to the kids. What happens there? You're effectively stretching that. So let's say, for instance, instead of each kid getting $2 million, if we're able to give them, let's say, $500,000 today, then what it does is it enables them to stretch that $500,000 over 10 years, so that if the second wave comes rolling in, then it's a smaller dollar amount.
Right.
Okay. Now, there are estate planning strategies that enable the surviving spouse to say, no, I don't want the assets, and then they go to the beneficiaries. Those are things that they should discuss with their estate attorney.
Right.
But it's an idea that we like to plant a seed in their head.
Yeah, and you should be aware that if you do implement this strategy, there is a 4.5% inheritance tax for whatever dollar amount goes to.
Correct. That's correct. At the time. Okay. Why? Because that happened once.
Yeah, it does.
They weren't expecting it, but by the way, it's 4.5% on a smaller dollar amount.
Right.
But anyway, so the other things that we were throwing out there was to make sure that they carve out an appropriate amount of income from their non-qualified assets over the next few years,
Right.
at least while we're doing all of these Roth conversions, because what we're trying to do is not only get money out of the pre-tax bucket, but boy, I'll tell you what, that tax-free growth bucket's a beautiful thing.
Oh, yeah.
And so to the extent that we can maximize the amount that's going into the tax-free bucket, let's use the non-qualified assets as long as possible. Because by the time that they run out of non-qualified assets, they have a big pot of money in the form of a Roth IRA that can serve as their assets to be grabbing from.
Right.
Okay. Then the next question that came up is, what are we doing about the pensions? Actually, go back on the slide, we talked about trust for the kids. That was an estate planning tool. We recommended that they go meet with their estate attorney. But what we did in our role as financial planners is we educate the clients to understand all the thoughts that go into estate planning, so that when they go to meet with their attorney, they have a better understanding of it.
Right.
Because what happens a lot of times, they go to see the attorney might make some sense, or they talk a language that is over their head. They leave the attorney, they look at each other, scratching their head, saying, what in the world just happened? I have found that, and we've gotten a lot of feedback from our clients, I've found that if we educate them before they go into the attorneys, they're so much better informed that they also get more out of the meeting with the attorney.
Right.
So, and establishing trust for the kids was one of them, because, the fact of the matter is passing no judgment on their kids, and any kids. Is it a wise idea to be dropping $3 or $4 million onto a kid in their 20s?
Probably not.
Probably not. Exactly.
And it also provides things like creditor protection, things
Correct.
like that. If they were to get divorced, keeping the money in the family, so to speak, or at least having it go to where you desire it to go.
Correct.
Is a very useful tool. And we've unfortunately seen that pitfall
Yes.
happen to a few people.
We have. So we actually had an episode. The last piece that comes up was, do we take the pension or do we take a lump sum? All right. And I'm going to summarize it pretty quickly. Of whenever there's a pension, it's called a defined benefit. All right. And that's exactly what it is. It's a defined benefit. The defined benefit says, whatever your plan says, may say, we're going to pay 2% times X number of years that you worked times your final salary. So if you've worked for a company for 20 years times 2%, and your final salary was $100,000, 20 times 2% is 40%. 40% of $100,000, your benefit's $40,000 a year. Yay. But they also give you the lump sum benefit option. Not always, but sometimes. And one of the things that I found, those that provide it, also, you got to understand how it works. The way it works is, if I am receiving a $40,000 benefit, what they do is, to establish the lump sum dollar amount, what they do is they say, all right, should I say I'm 39 years old?
Yeah.
All right, I'm 39 years old. Let's see if you buy that. All right, I'm not. All right, but let's say you got a 60-year-old. Let's go with Donna. Donna's 57. There we go.
There you go.
So what they do is they say, all right, how much money do we need to set aside for Donna to pay her $40,000 a year? So they say a 57-year-old, they do not differentiate male from female in this particular calculation. They say, how much do we need to set aside to pay this individual for the rest of their life? And they use actuarial tables, and let's say the actuarial table says that the 57-year-old should live 25 more years. Okay, so they say, well, how much money do we need to stick into an account to pay $40,000 a year for the next 20 years, 25 years? The missing variable is interest rate. Well, okay, if the interest rates, and I'll exaggerate to this extent, was 100%, well, they only need to put $40,000 into the account. Because that $40,000 is going to spit out $40,000 a year.
Right.
Cool. But if the interest rates are 0%, then basically $40,000 a year for 25 years, they need $1 million in that account. So the difference between 40,000 and $1 million, it's kind of significant.
960,000.
Yeah, right, exactly. So what it comes down to is, what is the interest rate? Now, we happen to be meeting with a client, and we created a table that shows the impact of interest rate hikes. So we met with him end of 2022, and he was 53 years old, as I recall, and said, I want to retire in 2 or 5 years. And oh, by the way, this is my lump sum benefit amount. So you look at the table, and his lump sum benefit at the, oh, it was 21. Okay. At the end of 21 was 1.7 million. If he was 55, 2.3 million at age 58, 2.5 million at age 60. And I know he was saying, hey, 58's the number. So then we met with him again. We're actually still working with him. And then all of a sudden, he reran the numbers in February. Interest rates rose. Why? This is when after they were raising the interest rates. Okay, this was 22 to 23. They do this every year. So we met with him in November of 22. Okay, November of 22, the pension calculations for lump sum were using the rates from 21. The interest rates at the time were 1.7%, at least the 10-year treasury was 1.7%. When they started jacking up interest rates in all of 2022, at the end of 2022, the 10-year treasury was 3.6%. 1.7, 3.6. What's a couple percent between friends? Look at the impact it had on his lump sum. Right. That one that he was looking at for age 58 dropped from 2.3 million to 1.6 million. Huge. It dropped by 30%.
Right.
Okay? And so what's the moral of this story? The moral of this story is it's okay to think about taking the lump sum, but you may consider timing it.
Right.
Okay? And so, for instance, you want to look back at the summary plan description of the pension. There are pensions that do it more frequently than annual, but if they say we're going off of the published, IRS published numbers from the end of the prior year, and we had interest rates run up this year, then you say, if I'm taking a lump sum, I need to hurry up and do it before December.
Right.
But if we see a year in which interest rates have dropped precipitously, and you're thinking about taking a lump sum, you may wait, let's say it's late in the year, you may wait until after January 1st of the following year to find out what the new numbers are published, to find out what your lump sum is. And we take some of this into consideration also in the case of Pete and Donna. We were taking a look at all the different dates with which she could take her benefit. So by us delaying the benefit by a year was not exactly detrimental to the client, because their benefit would have gone from, and I don't know the exact numbers, but let's say it was 40,000. If she waited a year, it might have gone to 41 or 42. So in fact, it didn't hurt her by waiting, because by waiting, it increased the actuarial amount for the payment.
Right.
Okay. But if she was contemplating the lump sum, then sometimes it makes sense to wait or to hurry up.
Right. And in their scenario, we actually had to factor in if they did take the annuity payment or the fixed payment option, that was going to increase their taxable income and therefore
Right,
decrease
reduce
the
the-
amount of
correct.
Roth IRA.
Correct. And then similarly, if we take it as a lump sum, then we're just adding more money to that bucket that we're trying to pull out. So, but again, these are all the things that we take into consideration. So anyway, we're going to wrap up on this episode. I hope everybody learned something here today. We touch upon, this is why we do the case studies. We don't expect everybody's unique, plain and simple. But the fact of the matter is that almost everybody has some nuance going on that will match the viewers. And if they can relate to any one of those nuances and get something out of it, a nugget, then the purpose of this episode has been satisfied. Because the whole idea is to provide an educational experience. Fun if you can. Some people wonder how you can get fun and entertaining out of this, but I love it.
It's fun. Yeah.
Thank you, Ryan, for your participation today.
Thanks for having me.
Thank you for watching, and we'll look forward to seeing you the next time, and have a wonderful day.